right, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm going to be talking about my busy last 6 weeks, and then more importantly, talk about loan hypothecations. Loan hypothecations are kind of a confusing, although be it popular topic lately. There's definitely a lot of discussion on those at DME here recently, and I seem to be getting more and more questions about them. So I'm going to talk about that a little bit in depth today. But before I get into that, I wanted to remind everyone, if you're not on my email list, that the Note Launchpad online course has its summer sale going on this week, and it ends on Sunday. So if you're subscribed to the podcast and you're listening to it when or soon after it comes out, there may still be time to take advantage of that sale. Note Launchpad is my flagship online course, over 30 hours of video, all the deal analyzers, checklists, and downloads that you need. It's a self-paced online course, but has lifetime access included with it. So through Sunday, you can save $500 for the full pay option using the coupon code SUMMER. And then there's also a temporary option that allows you to spread payments over 10 months instead of paying it all at once. But even if you do that 10-month option, you still have lifetime access to the course. I'll put links to that in the show notes. But now let's kind of get into today's episode. So last 6 weeks or so have just been super busy for me. So I had a trip to Mexico that I think I talked about a little bit previously. I had a daughter graduate from high school and had family come into town and visit. Then went to Nashville for the DME conference. And then more recently did a family trip to the Bahamas for a week. That Bahamas trip was super fun. It was a kind of a family reunion type thing on this really small island called Manowar Key. And the whole island's maybe 2.5 miles long. You actually have to fly in to the island next door and then take a ferry boat over to get there. Super rustic, not a lot of stuff on the island. Everything closed on Sundays, and was also there for their Labor Day, which they didn't have anything open at. Well, it was a lot of great time. Got a lot of good snorkeling in, a lot of beach time. We did a couple of boat days, which was super, super cool. My sister somehow found this deal on a 46-foot catamaran with a captain, and kind of did some island hopping and other things. And so that was a blast. And, you know, in the midst of that, I was able to keep up with my notes business. So one of the things I love about the business is you can do it from anywhere. So I was able to keep up with emails during all of my 6 weeks of travels, did a number of phone calls. One tip I recommend if you're going to work while you're on the road is picking up a portable travel monitor. So I've got a small monitor I can plug into my laptop, fits in my carry-on. There are even some smaller ones you can throw in a backpack. Because when I'm actually doing work, I like to have two monitors set up, and they're super cheap and really portable. So really nice to be able to keep working while you're on the road. The only downside was it's hard to do really kind of deep work and longer projects and things when you're traveling. So now I've got the next, as of recording this, the next about 2 months or so in front of me with no more travel. So I'm going to be really heads down, putting out a lot of new content over the next 2 months, and we'll definitely be a lot more active on social media and in some other places. So I've definitely been thinking about a number of things related to notes, you know, over the last 3-4 months or so. And so looking forward to writing some of those ideas down and sharing them with you all. And in addition to all of that content, I've also got a free workshop that's going to be coming up. That's still in work. I don't even have the date nailed down, but keep your eyes peeled for that. And I always suggest getting on my email list. I'll have a link for that below too, if you want to be notified when that's going to be available. It's going to be a couple-hour workshop where I talk about specifics on deals I'm doing right now in 2024. And it's totally free. I'm going to have some students on there with me talking about some notes that they've been buying and deals that they've been working on. So I think it'll be a lot of fun. So keep your eyes peeled for that in the next 1 to a couple weeks or so, depending on when I get it ready. And so what I really wanted to talk about most today, though, was loan hypothecation. So hypothecation is a big, kind of confusing word that I hate. I've actually been trying to come up with my own word for that. That's a little simpler and easier to understand. But really, all a hypothecation is, it's when there's a loan that's collateralized by another loan. Okay, so in some ways, it's a little bit similar to a partial. So basically, what you do when I want to do a hypothecated loan, I go out, I buy a mortgage note, right? It could be a mortgage, could be a land contract, or whatever. And then I simply take a loan from another investor. So I'm borrowing money from an investor. And then the loan they're making to me is collateralized by the loan that I bought, right? So unlike a lot of real estate deals where maybe you take a loan from a bank, it's collateralized by a piece of property. In this case, you have a loan that's collateralized by another loan. And then the way that I set these up is the loan is still assigned to my company, right? So that way I can have it within my servicing account and I have control over the note. And then I'm simply making monthly payments to the investor that I took the loan from. So in a lot of ways, this is similar to a partial, but it has some little differences. With a partial, you're actually selling a number of payments, okay, on the loan. In this case, you're just taking the loan from an investor. So what happens is I'm usually buying at, some higher effective yield, maybe 11 to 15% or so. And then I'm taking a loan from an investor at 8 or 9%. Okay. So every month when the payment comes in, there's the P&I that comes in from the borrower. And so a portion of that I'm sending to the investor. There's another portion of that I'm using to pay servicing fees. And then it leaves a little bit of extra for me that I call the monthly spread, right? So when you set up a hypothecated loan, one of the advantages for the operator is you're creating these little bits of monthly cash flow. Now, a lot of times, depending on the size of the loan, the amounts of monthly cash flow aren't necessarily huge. One of the things I like about the model is it's very scalable. So you can go out and do a bunch of these, and now the monthly income you're generating increases. But where the profit really lies for the operator who's doing this is, unlike a partial or a joint venture or some other structures you could use to work with people who are giving you outside money, if the borrower pays off the loan early, you get that early payoff where now you're collecting the entire UPB, you basically profit the discount you received on the loan when you bought it. So as the operator, when you're doing hypothecations, you're making little bits of monthly income, not very big, but you're giving yourself the option of getting an early payoff, which is nice. And of course, you can't schedule when those come in. They come in, periodically. And for some reason, for me, strangely, I've had a handful of borrowers who have refinanced their loans and paid off early. And I have no earthly idea why I've got a bunch of borrowers doing that right now in this environment. That honestly doesn't make any sense to me, but nonetheless, I'll take it. It's always a win when that happens. One of the other things I like about hypothecations, just like my relationships with borrowers, where my relationship, when I look at my relationship with the borrower, our incentives are very well aligned, right? Typically, when I'm buying, let's say, a non-performing loan, borrower wants to stay in their home. I don't want an REO. And so we can both kind of work together. When I do a hypothecated loan with an investor, it's very, very similar. So the kind of investor who buys a hypothecation is, typically they are investing often in a self-directed IRA account. They're typically getting a high single-digit return that's really pretty passive, right? Like they're just receiving money every month. And for people who are interested in getting involved in notes, but they want to learn a little bit more, sometimes doing a hypothecation with someone else who's more experienced is it's not a substitute for training, but it's a way to see a note deal in action and get a little more exposed, review a collateral file and the pay history and everything else associated with the deal. And then one thing I should call out too that I didn't actually explicitly mention earlier, with hypothecations, just like with partials, right? We're targeting performing loans. This whole thing only works if the borrower is actually paying. So as the operator, when you're looking at candidate loans to buy to do hypothecations, the more stable, the better performing that is, the better it is for you. Because one of the risks you have as the operator, at least the way I set them up, and again, the devil's in the details. And I think if you talk to, I've actually talked to several investors who are setting these up, and I don't think that any two do it precisely the same way. But the way that I do it, if I have a hypothecated loan and the underlying loan stops performing, then I'm on the hook to do the foreclosure and either sell the loan off, pay back the investor, take it through foreclosure, work something out with the borrower. So that work and that expense is on me, right? And so there's no free lunch, and that's all the more incentive to scrub the loans that you're doing this with. Now, the way I actually set these up is if the borrower starts paying, I could theoretically stop making payments to the investor while that happens. Now, of course, the interest to the investor is still going to accrue. In reality, what I like to do, and I think this is the best practice, is I like to set up automatic ACHs to my investor where they just get paid every month. And then I run my business so that I have a pretty significant cash cushion. So if I have some borrowers miss payments in a given month, it's not a big deal. You don't ever want to be running anything financially close to the line as an investor. But that foreclosure risk is definitely there. And I have had hypothecated loans that have ultimately had to foreclose on, right? And I just paid the investor while that was going on, incurred the other costs, and then got made whole when I completed the foreclosure and sold the property. Now, the other risk you have is if you get the property back, and just like any non-performing loan, sometimes the property's not in good condition. Actually, just had one recently to kind of highlight some of the things to be careful of and the risks and things. I had a loan, this borrower had been paying reliably for at least 5 years. I had originally bought this note back in 2019. Older gentleman, paid reliably, nice guy, had talked to him on the phone once or twice. He passed away. Obviously, when he passed away, he's not paying anymore. And when I got the property back, found that this guy was living a super rough lifestyle. It was basically, I don't know if I'd call it a full-blown hoarder house, but it was really bad, had a lot of problems, a lot of deferred maintenance. And when I first got the report from the realtor, I was like, oh man, I'm in trouble. I'm going upside down on this one. Now, as it turns out, it looks like I'm actually going to get out with a small profit, assuming our sales close. I don't want to talk about it too soon and jinx anything because the story's still out. But do realize, right, it's very important when you set these up that you're doing your due diligence on the underlying loan, and financially you're operating in such a way that you have a cash cushion, because sometimes stuff does happen, right? And we want to make sure we're prepared for that and we're able to handle it. Now, when you're looking for notes to set up hypothecations, like what are some of the things we should look for besides the basics, like a solid pay history, borrower having equity in the property, things like that? Well, what we're trying to do, right, is we're trying to create a little bit of monthly income. We're trying to create the largest monthly spread that we can, and then we're trying to leave ourselves the maximum upside. And if you look at loans, there's basically 4 variables, right? The principal balance, the number of payments remaining, the interest rate, and then the payment amount. And one of the things you can look for is actually shorter loan terms tend to make for better hypothecations. That doesn't mean you can't hypothecate a loan that has 25 years left on it. I do those all the time, but you can create more favorable economics for yourself when the term is a little shorter. And basically, the reason for that is you're borrowing a loan at some discount. When the term is shorter, you're capturing that discount faster. And so your ultimate return is higher, but the return you're paying to the investor is the same. And so you're creating a little bit larger spread. One thing I want to call out as well is when you're setting up the hypothecated loan with the investor, you can do that investor loan interest only. And sometimes I'll do that if the loan has a very long term. But if it's a little shorter, say like under 20 years or so, then what I'll do is I'll amortize the investor loan at the same period of time as the underlying loan, right? So that way, as the borrower is making payments and the unpaid balance on the loan is coming down, and you're making payments to the investor and the balance on the loan they made to you is going down, those two things track together, right? Like if you were to just pay interest only to your investor and you do that for long enough, now the balance on the underlying loan is going to go down. The balance on the loan you owe the investor is going to remain the same. And that investor loan is no longer going to be fully collateralized by the underlying loan. It's just not a good situation for everybody. So that's one thing, important thing to pay attention to when you're setting these up. Now, the second thing is larger balances on the underlying loan are better. And this one's kind of straightforward and obvious, right? So when we look at whether we're buying loans or hypothecating loans or doing partials or doing whatever it is, it's generally the same amount of work, right, per loan, no matter whether it's a small balance or a large balance. So all things being equal, try to do a larger balance. Now, the rub with that is if you're doing a really large balance loan, then there's going to be a shorter pool of investors who are willing to give you a hypothecated loan on that, right? So there's a little bit of a balancing act that happens. And then the third thing is the higher the interest rate on the underlying loan, obviously, the better that is, because it's going to make it easier for you to create a spread. Now, when you set these up, you're going to want to go to an attorney to get the paperwork set up. There are some nuances in there. You want to make sure that you do this in the right way so that you are not creating a security. Now, I'm not an attorney. I can't speak to all those nuances. I use Brian Gallagher from Maryland to set mine up. I recommend talking to Brian or someone similar to get yours set up. But mine paperwork actually has 3 separate documents in it that get signed. And so that's what defines the loan from the investor to me and secures the loan for the investor. And then some other things to keep in mind are like reporting to your investors. Now, when I do joint ventures, which are a different animal, I do regular reporting every quarter. I provide investors with all the QuickBook details and all of that. With hypothecated loans, for the most part, I just send them money. If something happens where I'm taking the property back or there's just something really screwy, I'll let them know. I'll just drop them an email just to let them know what's going on. But for the most part, I'm just taking care of it and I'm sending them money one way or another, right? But it is important just in general to be, to communicate well with your investors, to let them know if there's something important that's going on, or if they do reach out and ask you questions, you respond to them in a reasonable amount of time. The other thing that's really important is if you're going to set up hypothecations as an investor is that you really stay on top of your bookkeeping. It kind of grosses me out how many real estate investors are just really loosey-goosey with their books and don't really stay on top of it, right? Like your checking account balance has nothing to do really with the state of your business, right? So you want to make sure, especially if you're using outside money, that you're fully reconciling your books every single month. And so for me, every month, I know exactly where I stand. And because I'm kind of a nerd, I actually still do my own bookkeeping. One of these days I need to break it out, but I'll actually update my books generally on a weekly basis. So I just like knowing exactly where I am what investor money I have, what my obligations are, what my cash balances should be, what my cash balances are, and all that kind of stuff. It's just part of being a responsible operator. And for me, it lets me sleep easy to know exactly where I am. So that's my quick, brief tour of loan hypothecations. Let me know in the comments what questions and other things you would like to know about these. I may do some other podcasts and videos where I deep dive on these a little bit more. So that's what I got for now, and I'll see you guys soon.